Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about two new covered call income ETFs from Roundhill Investments, and they are XDTE and QDTE. And these are the first ETFs to ever offer weekly distributions. That's right, you no longer have to wait a full month to get that paycheck. You can get it every single week with these two new products. So, want to learn about them? If that is what you're looking for, please stick around. Boop. So Roundhill Investments has been around since 2018, and I have reviewed one of their other products that was MAGS. I'll link that up above. That's all about the Mag 7, but they've got a lot of innovation going on over there. So I had the opportunity to talk to Dave Mazza. He's the CEO this past week about these two new products. I thought I'd share that info today. So we have two different products here, but they're essentially the same thing, only they're based on a different index. The X means S&P 500, or the Q means the NASDAQ 100. So the makeup is essentially the same. They don't have any equities that they hold inside of this. It's all just an option strategy. So XDTE utilizes a synthetic covered call strategy, meaning, we don't have those equities just held in this ETF. Everything is done with options. It seeks to provide current income on a weekly basis. Those are those weekly distributions, while also providing exposure to the price return of the S&P 500 index. So if you're familiar with options, and maybe you've heard of a poor man's covered call, it's going to be a similar setup to that, where we're going to have a long exposure by buying long calls, and then we're going to be selling 0 DTE daily options. So let's talk about the option strategy. But just to be familiar, X, S&P 500, Q, NASDAQ 100. So if we look at the holdings for either one of these products, the first thing we're going to see is a very long-dated, deep in the money call option against the index. Okay, in this case, it's SPX for the XDTE. If we looked at the NASDAQ one, it would be against the NDX. But it's a very deep in the money call. This one's out about 9 months from now. And this is going to act as if we own those shares. It's going to give us that long equity exposure. So in a rising market like we have right now, we're going to get that benefit of the SPX or S&P 500 going up and up and up. So this gives us that long exposure. This provides upside that we can sell calls against. And for QDTE, you're going to see a similar setup, but they're going to be using NDX index options. And these are created using what are known as flex options, which aren't really retail friendly. So if you wanted to do this yourself, you're probably not going to do the same thing with index options, which brings up an important point. You know, when you put this all in an ETF wrapper, we're going to get the benefits of what are called 1256 contracts, which gives you tax benefits, 60-40 tax treatment, 60% long-term, 40% short-term. So by having this in an ETF wrapper, we are getting some nice benefits. Whereas if you did this yourself, unless you have a very large account, you're probably going to be using something like SPY and QQQ, which won't be as tax friendly. So that is one consideration as you're going through this. If you're thinking, how can I do that myself? Which you certainly could. I'm not opposed to it, you know that. But something that you should think about. So now that we've established our long, deep in the money call option against either NDX or SPX, we can start selling daily out of the money call options. And we're going to do this again every single day at the open, 9:30 a.m. Eastern time. Those are going to expire at 4 p.m. Eastern time that day. And all this is again done with index options. So you're going to get that tax benefit of those 1256 contracts. Everything will be settled in cash. No worries there about assignment. And these daily call options are sold in the range of 0 to 50 basis points out of the money. So anywhere from at the money to about 0.5% out of the money. So the ideal situation for a product like this is that you sell these out of the money calls and the index heads straight towards the strike price that you sold. In that case, you get to kind of double dip. You get the rise in the long calls up to that strike price, plus you get to collect all that income. And then the options expire worthless on a daily basis. You're just raking it in. Feels great. But that's not always how it works out. So if we look at last Friday, for example, the index finished at 20,391, and the call sold was 20,270. I'll put that up here now just to kind of show you. So in that case, we overshot the calls that we sold. And in this case, it's likely that we lost on this option position, meaning to close that position at the end of the day on Friday, it's going to cost us more than what we sold it for in the first place in the morning. Now, not all is lost because we still have our long equity exposure, but we're not selling that on a daily basis, right? We're trying to generate income from these short calls. So in that case, they have to decide what we're going to distribute. Now, where NAV erosion can come in is when we get a lot of unexpected volatility where it's not expected. So we're getting these up and down moves really quickly and violently. In that case, we can have NAV erosion with this or any other covered call ETF, especially if they're committed to routine distributions. So if they're going to be putting money out there, they've got to figure out where it's going to come from. So that can occur, and that's where NAV erosion can occur. Is it going to go to zero? No, it's not going to go to zero. But there can be times where you're going to see that in this product. Now, the rest of the information that you see here is going to be coming from Seeking Alpha. I am a Seeking Alpha affiliate. There are affiliate links down below, so it's a great tool to research stocks and ETFs, so check it out. But in this case, I just want to take a look and show you because I know people are interested in the distributions from these two products. Now, they do vary quite a bit. So in this case, we're looking at XDTE. And we can see the dividend history is anywhere from, let's see, this tiny little one of 2 cents. And they said they are committed to distributing something every single week. But you can see it can be all the way down to 2 cents in this case, or as high as 37 cents. And this is for XDTE. So you can see what it looks like there. And then for QDTE, if we scroll down, we're going to see that same week, it looks like only 9 cents. And all the way up to about 37 cents, 35, 37, 36, 33. So obviously with QDTE, you're going to get a little bit of a higher distribution because it's a more volatile product. But because they're varying these, there could be times when it remains low. And I know a lot of people are they're drawn to the Qs versus SPY because they have a larger distributions. But as we get more of a broadening out in the market, which I think will occur at some point, other products like JEPI versus JEPQ or SPYI versus QQQI, you might see better performance still from the S&P 500 versus the QQQ. So if you've only been investing for a couple of years, you might see a shift there, even though you see typically more volatility in a product like the Qs versus the S&P 500. So wanted to mention that. But nevertheless, if you average all these out for XDTE, the average has been around 20 cents, and for QDTE around 26 cents. Now, both of these products are new for 2024. They just got their start back here at the beginning of March. The expense ratio is fairly high, 0.95%, so that's something you have to be okay with, but that is pretty steep. Again, every single week they're going to be distributing some money. You can see the yield right now is 5.83%. That's based across the whole year. But if we take that 20 cents, which has been the average so far for XDTE, we're looking at around a 20% distribution yield. And for QDTE, it's around 30%. So pretty darn high. We'll see how they do. But so far, XDTE is holding up pretty well. And we'll look at performance here in a minute. Assets for the XDTE are 17 million, and QDTE, because of that more attractive yield, I'm sure people have made that one about 4 times higher at about 61 million. So those are the two products. Let's look at performance. So again, these products have only been around since March, but let's look at early performance compared to a couple other similar products and the index that they follow utilizing this option strategy. And again, this is total return, so all those distributions included in the return. We're looking at XDTE at around 7% since March 7th, the last 119 days. QDT up about 8%. JEPI, popular covered call ETF, up just 1%. JEPQ up about 8%. SPY up about 8.5%. And the Qs themselves up 11.7%. So based on their index, they're holding up there pretty well. Again, selling a call is kind of a limiting behavior. So sometimes you're going to get that underperformance. It really depends on, do you want this income, and are you willing to pay the taxes on it? If there are taxes due, does that make sense for your portfolio? But so far, it's not terrible, right? It's doing pretty well, especially when you compare it to a couple of the other similar products that are really popular. So performance looks pretty good so far from these two new offerings. They are a watch list item for me at this time. I do own a few different covered call ETFs, but it's a small portion of my portfolio. I also like to do a lot of these types of option trades myself. And again, if I was going to do this and simulate it, I would do a poor man's covered call type of a setup with SPY or QQQ. But I love that we keep pushing the boundaries with these types of offerings. We keep looking at new and interesting ways to utilize options and be creative to create income. So yeah, it's one of those that I will keep on the watch list and see what they come up with next. So 2 new and interesting products from Roundhill Investments. Let me know what you think about XDTE and QDTE. I'm sure a lot of people are going to be hooked on the fact that they get that weekly paycheck. They don't have to wait a whole month anymore. So they'll be looking at these. I'm not a big fan of the expense ratio, but I know 0 DTE options are so hot right now. It dominates the options market. So let me know what you think. Is this a buy? Is this a watch because they're brand new? Let me know down in the comments what you think. If you like this type of thing, please like and subscribe, and we'll see you next time. Have a great night. Whoop.